Good afternoon, everyone, and welcome to our third quarter economic update and market outlook with some of the best and brightest and fresh faces of Forvis Mazars. I am Katie Jaskinia. I'm the office director for the Southwest, which is right now known as the hottest part of the United States. I am based in San Antonio, Austin practice unit and specialize in wealth management and financial planning, and have the pleasure of being your moderator today and having a conversation here with friends about things that hopefully is not keeping you up at night, but certainly may be on your mind, and encourage you to use that Q&A box if you have any questions that we do not cover today. But I will kick it off for you all to meet my friends here, and I will start with Liz to give an intro.
Well, thank you, Katie. My name is Liz Britton. I am a tax partner and also the Southeast Regional Industry Leader for Private Client. I sit in the lovely mountains of Western North Carolina in Asheville, a little bit cooler, I think, than we're dealing with Katie over here. But I spend the majority of my time serving individuals and families and helping them and our team's plan to support. And I am just delighted today.
Matt?
Yes, thank you. My name is Matt Wall. I'm a managing director in the Little Rock, Arkansas office, and I'm also one of the portfolio managers, which means when our clients see those trades happen in their accounts, I'm one of the ones that's pushing the buttons on that, and I'm also a member of our investment committee.
Fantastic. And Stephanie, last but not least.
Yes, good afternoon. My name is Stephanie Hurt, and like Matt, I am a portfolio manager, but I am based in Southern Missouri, and I too serve on the firm's investment committee.
So we definitely have knowledge and expertise. I'm sure what you heard today, we're going to have some investment, but then we're also going to have some tax overlap with Liz's expertise. But really kicking it off, it's been an exciting week in the markets, and I'm sure that's on everyone's mind. So this was extremely timely. But Stephanie, how are things looking for 2024?
Yeah, great question, Katie. I think a lot of people are wondering, with the volatility we've had this week, what those returns might look like. Now, this data that I have up on the screen, this is through the end of the second quarter, but I'll speak to also the recent market returns. So when we think about what the markets have been doing, really what we've seen from U.S. and international stocks has been a continuation of the great returns that we saw in 2023. And then on the bond side of things, returns have been slightly negative. So while bond investors are being able to take advantage of higher yields, higher interest rates, as interest rates have moved higher the first half of this year, that has brought prices down. And so that's why total returns are a little bit negative. And then alternative assets have performed in line with what we generally expect from that category. So alternative assets are anything that's not normal stock and bond exposure. And we would expect a return higher than bonds, but not as high as the stock returns. And of course, that's what has been delivered year to date. And then as far as here more recently, I know the last week or so has been jarring for some investors, particularly Monday. But even with some of the recent down days that we've had as of late, year to date, the S&P 500 is still up around 10%. And if you think about that in the context of being about 7 or so months, that's still a pretty nice return, even if the market has recently given back some of the returns that we had had.
Yeah, absolutely. It's obviously there that stocks are really being the driver of the returns. What's been that main driver underlying the stocks on kind of getting that double digit that we're seeing for year to date?
Yeah, so really it's a lot of different factors. One is things have gone better than expected with all of the tightening the Federal Reserve Bank did. One would have reasonably expected that to really slow down the economy, but the economy has actually been pretty resilient in the face of all that. So the economy has been doing better than expected. Also, corporate earnings have continued to be solid. There's been a lot of enthusiasm around artificial intelligence and the prospect of what that could do for corporate earnings and driving efficiency. And so it's been a myriad of things that's really been beneficial, as well as the prospect of the Fed cutting rates. And if the Fed were to start cutting rates, that would be supportive of higher asset prices.
Interesting. Okay. So looking at kind of Matt, I think here would be a good place for you to jump in, since we're giving people just so much content here, 7 minutes in. It's good to see that stocks are up, but not have all U.S. stocks done well.
Yeah, it seems like a trick question, Katie, based on when we put this information together, the June 30 numbers, everything looks pretty good. And to give the attendees a little background, when we make these presentations, there's always some slides that are just inherently easier to explain than other slides. And this is one that on the face of it, when we put this together, this was a pretty easy slide. U.S. stocks look really good year to date. On the left side of this page, we have kind of the traditional 9 style boxes. So that's broken up by the size of the companies, large, mid, and small, and then also the style, kind of value, core, and growth. And again, looking at the left side of the screen through June 30, in general, large cap stocks have done better than both mid and small, and large growth stocks in particular, growth in particular, had done better than the rest of the market. And so some of the names you'll hear, like the Magnificent Seven, help push that large growth bucket up to about 20%. And so that was pretty easy to explain before the volatility of last week. And just if you think about what happened on Monday when the market opened, you're looking at news headlines of a global stock market sell-off. The S&P opened down 5%, the NASDAQ opened down 6%. Some of those Magnificent Seven stocks were down about 10% intraday. And so all of a sudden it made this data a little more interesting. And so I went and pulled the numbers through yesterday just to kind of see where they are after all the volatility. And since Liz just joined us for the first time, I thought it would only be right to ask her a question that when you think about these 9 style boxes, as of June 30, only one of the 9 was negative. And so just based on volatility, what you see in the news, do you have a guess as to how many of those 9 style boxes are negative now, kind of through market close yesterday?
And the only wrong answer is over 9. So
1, my guess.
All right. No, 1's a great answer. So interestingly enough, I ran these slides past my wife last night. Her name is also Liz. She also said 1. I would venture a guess that if you called some of our clients, especially the nervous Nellies, and you said how many of these 9 style boxes are negative, it wouldn't surprise me if you get a number somewhere between 3 and 6. And I know there's at least one person I could call and they would always say 9 because they're always kind of worried about something. Interestingly enough, the answer is 0. All 9 style boxes are positive through yesterday. Now, certainly when you had the volatility in the market, it was felt most significantly in the large cap space. So as Stephanie mentioned, the S&P was closer to about 9% instead of where this kind of shows 14. That large cap growth bucket actually dropped from roughly 20% down to about 10%. So if you remember, I mentioned some of those Magnificent Seven stocks had some large intraday drops. You saw that come down. But parts of the market actually held up pretty well. So that large cap value segment is actually a little bit higher today than it was at June 30, which is a little surprising given everything going on. And that small cap value bucket on the bottom left, it's actually slightly positive. And through some of the volatility last week, you had a rotation from kind of large cap to small and mid cap. And so even though some parts of the market were down, you had other parts of the market that benefited. So interestingly enough, given all the volatility, everything going on, like Stephanie mentioned, it's still a pretty decent year for stocks. And actually all 9 of those style boxes are positive.
yeah, so definitely I hope everybody who's here listening with us today and getting educated can exhale a little bit and take a deep breath, that it's not all bad news. And I did hear you mention Magnificent Seven, and I assume Charles Bronson isn't going to come out on a horse on the next slide. or what you have to present with us today. But explain to me a little bit more about Magnificent Seven.
Yeah, I definitely would have loved to have used the Charles Bronson slide. We couldn't get the approval for it. We did have this one, which is kind of close. And when you think about that Magnificent Seven, basically it kind of includes Apple, Alphabet, Amazon, Meta, Microsoft, NVIDIA, and Tesla. And part of the reason they call them the Magnificent Seven is if you look on this chart kind of near 2023 and you just look at these 7 stocks, the best stock had a return that calendar year of 239%. And the worst return of the 7 was 46%. And you average that together, those 7 stocks contributed about 70% in returns. And you can see that in the chart on the left of just how the green line is the performance of those 7 stocks. And they've just done really, really well. Now, you've seen that cool off a little bit here in the last week. But that's kind of why you get the name the Magnificent Seven and kind of why everybody watches them. That has been where most of the earnings growth has been and where a lot of the price performance in the market has come from.
And how is it that these particular 7 affect the valuation of the market?
That is a very good question. And some of this comes with the concentration of the market. So if you look at those top 7, they make up kind of around 30% of the market. This chart actually looks at the top 10. So on the top right of this page, you can see the percent of the total market and almost kind of 1/3, really a little higher than the market cap of the entire market. So because of that, they can overweight kind of what's going on with the valuation of the market, almost sort of like the tail that wags the dog. If you look in the middle of this, kind of on the left, you can see the current PE of the top 10 stocks. This will include the Magnificent Seven in there. It's about 30 times earnings. So that's on the higher end of where we see multiples. And if you think about the remaining 490 stocks in the S&P, it's less than 18 times earnings. But when you blend it all together, it gives the S&P as a whole a valuation of 21 times earnings. So certainly those kind of stocks by themselves will pull up the valuation that we see in the market. It is still important just to note that when you look at the market as a whole, in general, things are still on the higher end of where we've seen valuations the last 20 or 30 years. But certainly those kind of 7 and 10 stocks by themselves tend to pull up the valuation of the entire market. So definitely something to be mindful of.
Okay. And Liz, want to have you jump in here too. It sounds like, we're hearing is it's not all bad news. There is still gains that have been made by investors this year, certainly in the stocks. Does this present an opportunity for some tax efficiency on some maybe charitable giving that some of your clients or our clients may have?
Absolutely, absolutely. There's a couple considerations here depending on your situation. When values of stocks are up and maybe let's say you have a really large built-in gain in your portfolio, it can really present an opportunity if you have some charitable intent to gift that stock rather than liquidating it or maybe gifting cash instead. Your deductions could be based on the value of the stock given, subject to certain limitations, but especially if you're already planning on maybe doing a rebalancing or diversification in your portfolio or planning on liquidating the stock anyway, just by gifting that stock directly to the charity can save you ultimately from recognizing that gain and realizing it, paying taxes on it, and then you still get the deduction on the full value. So that can be a really strategic planning opportunity. Additionally, if you happen to be in a position where you're taking required minimum distributions from retirement accounts, another thing to consider that's really often helpful for clients from a tax perspective is to direct that RMD, that required minimum distribution, directly to a charitable organization that's qualified. Instead of taking that RMD into income. As a result, what this can do is essentially lower your adjusted gross income without having to take an itemized deduction. Maybe you aren't taking itemized deductions because they're a little higher right now, something we'll talk a little bit about later. But this can also provide advantages to certain phase outs or thresholds that you might experience due to the amount of income you have. So it can be a really effective tax planning tool to make sure you're realizing the benefit of your tax deduction to charity, but also considering other impacts it might have on your taxable income as well. So charitable deductions can be planned from a timing perspective to maximize attributes, or if there's maybe a large income event to help offset some of that taxable income by maybe making a specific donation or even setting up donor advised funds. That's something that we see quite often, where maybe the benefit of maximizing a large deduction is needed now, but the plan on how to use that charitably, it might be something that's more future focused. So it gives a lot of flexibility, but this is certainly an area to coordinate with your advisors and discuss, what is the best way to give thoughtfully and intentionally to maximize your current impact. And with that, I think it is time. Yeah. And I think we're ready for our first polling question. Is it time?
Yeah, let's do it.
All right. So we're going to focus on summer vacations here. When you're going on summer vacation, which do you prefer? The beach, the mountains, the city, or you don't like to travel in the summertime?
So we'll give everybody just a minute or two here to answer that and give us a flavor of where you like to go. And then we will move on into another topic after we kind of see those results. Hopefully you're all enjoying this kind of blend of economic update, understanding a little bit more of what you're going to be hearing, but then also overlaying this tax component, which is part of Forvis Mazars. We work as a team. So we're going to kind of keep this format as we go forward, talk a little bit more about different market areas, but then also have Liz, just because we have so many, I don't know if I would say exciting, because I'm not a CPA, but certainly lots of developments that she's going to share with us today.
It's exciting to me, so I think everyone should be excited about it. Yes.
Agreed. So surprising there, 56% beach, 33% mountains, 6% the city, and 3.8 of don't travel in the summer and don't have a preference. So we will move on. We've talked about the stock market, feeling a little bit better, took a deep breath. Tell me, Stephanie, how is the economy doing?
Well, as I mentioned earlier, when we were talking about the robust stock returns, part of the reason why stock investors are so excited is because the economy has been doing better than expected. And generally what we would expect for economic growth in the U.S. is around 2% GDP growth, and GDP meaning gross domestic product. And this chart on the left helps illustrate, how that we came up with that 2% figure. Sometimes the economy grows a little faster than that. Sometimes it's unfortunately in a recession, but on average, the U.S. economy is growing around 2%. And in the back half of last year, economic growth actually accelerated to above those levels. In the first quarter, it moderated a little bit, but the initial estimate for second quarter GDP is over 2%. And then the Atlanta Fed Bank, they have a measure called GDP Now, where they attempt to estimate the economic growth for the current quarter that we're in. And that reading is currently north of 2%. So I know some of the recent market volatility has been caused over recession fears, but as of right now, the data generally is looking good. And I think whenever we think about economic growth or GDP, it's important to understand the underlying components. So you just kind of know how to weigh certain factors and how important they may be or not. And you can see that data there on the right. And you'll notice that roughly 2/3 of GDP is consumption or consumer spending. And the other components being government spending, investment ex housing, and then net exports. And net exports is actually a drag on our economic growth because we import more goods than we export. But with consumption being roughly 2/3 of what's driving economic growth, how the consumer is feeling about things, whether they have a job or not, how that consumer balance sheet is looking can really have an influence on the economy.
And so kind of in that same line of that big blue box, how are consumers?
Well, overall, I would say that consumers are doing pretty well. So from a consumer balance sheet perspective or a household net worth perspective, you can see there on the left, assets are substantially outstripping liabilities. And when we think about what is primarily composed, what the composition is of consumer assets, it's homes and it's financial assets like investment portfolios. And home values have increased substantially, securities portfolios have increased substantially. So consumer asset levels are near the highest they've been. And then when we look at the liability side of things, the biggest component there is mortgages. And while interest rates have shot up, and so borrowing costs have shot up, that really isn't impacting most mortgage holders because most of the mortgages out there on the books were originated when interest rates were lower. So most mortgagors are continuing to benefit from the low mortgage rates we used to have. Another thing to look at is that household debt service ratio, where it's comparing debt payments relative to personal disposable income. And you can see there on the right of that chart that reading has popped up the last couple of years, but basically we're just back to where we were prior to the pandemic, which the pandemic timeframe was an anomaly for many data points and things. So really we're just back to where we were pre-pandemic. One thing to maybe keep our eye on over time is the delinquencies on consumer debt. And that's what's in that bottom right-hand corner. That blue line is looking at delinquencies on auto loans, and that gray line is credit card delinquencies. And those have shot up even past the levels they were prior to the pandemic. And then student loan delinquencies are quite low, which is a reflection of some of the programs that have been implemented that have impacted those borrowers.
Yeah, that stark orange line there dipping below. I'm so glad you explained that because I was going to ask you the question of, what's going on there, but thanks for explaining. So Matt, I know the labor market is so closely tied to health of consumers. How is that looking?
Yeah, Katie, I appreciate you asking that. And it really feels like I got all the trick questions in this presentation.
I know.
So when we put them together, as of kind of June, the labor market was actually pretty solid. So if you look at the gray line on this chart, this is the unemployment rate. And then the blue shaded line is wage growth. And so you can see that the unemployment rate was pretty steady down below, right around 4%. And then here recently, again, just in the last couple of weeks, some labor numbers came out where the unemployment rate had increased. And one number that people watch is sort of the pace that unemployment increases. And there's some research that shows if you look over time, that when you have an increase in unemployment of 0.5%, it just means there's a higher chance of a recession. Now, you have to remember kind of the joke for all economists, which is they've predicted 10 of the last 3 recessions. So whenever you see a metric that says, when this number goes here, watch out for a recession, just bear in mind, they're looking at history. You're just trying to understand what's going on. And certainly we have seen an uptick in unemployment, but you have to think a little bit about where that change is coming from. And so not that there's good changes in the unemployment when it goes up, but there's certainly bad changes in unemployment when it goes up. And if you look at kind of just a little to the left there at the end of the chart, that spike in the pandemic, that was people being laid off. That was people that no longer had a job. And so when unemployment spikes that high, that's a really bad sign for the economy. Recently, when we've seen the unemployment number go up, it really has to do with more with how the number is calculated. And you've actually had kind of more people entering the workforce, and the growth in the number of jobs hasn't kept up with the number of people that are coming into the workforce. And so it's not that we're losing jobs and you have less people employed, it's just that you have more people that are now looking for jobs. And again, the new jobs aren't keeping up. And so not that there's a great reason for unemployment to go up, but it's just not the harbinger of bad news that you tend to see when the that unemployment number increases. So it's certainly something to keep an eye on. The other thing I would just point out is, I'm dating myself, but when I was in college, call it 25 years ago, in economics, we learned that there was a natural rate of unemployment. So there's a certain level of the population for many reasons that will just be unemployed. And historically, that natural rate of unemployment was 6%. And this kind of lines up, if you look at the unemployment rate kind of over the last 50 years, it averages about 6.2%. Currently, the unemployment, is around 4.4, 4.5. It's still well below kind of what would be considered normal. And so from that standpoint, you could argue that the labor market really right now, it's really just trying to figure out how to normalize. You had a lot of disruptions from the pandemic to now, and think it's basically just trying to figure out a way to get back to normal. But certainly there's been some movement there, and something that we will continue to keep an eye on.
Okay. So we've talked to debt and we've talked to jobs. I think inflation is another word that we've kind of had very frequent in our vocabularies since about 2022, and not certainly since then. How does that broadly look today?
Yeah, so you finally gave me a topic that everything kind of looks the same, and the trend hasn't changed since we put these slides together. Yeah. And so when we think about the inflation number, think about the consumer price index. So this chart on the blue line, that is the headline CPI, and then the gray line, you kind of have the core CPI. And the important thing to note is that it's all sort of moving down. So if you look at the 2022 is when inflation sort of spiked and peaked, and then it's been sort of steadily coming down in 2023. It's not coming down kind of as fast as anybody would like, and it's kind of plateaued a little bit at the level where we are. But the expectation is it'll continue to kind of slowly go down from here. And it's roughly around 3%. The Federal Reserve has kind of put out there that they're really looking for kind of more of a 2% number is what their target is. So it's hard to say if we're actually going to get all the way to that target, but things look a lot better today than where they were. And if you just kind of transport yourself back to 2022, there's a point in this chart where late in the year, CPI had hit about 9%. And at that time, you didn't know if it was going to 12 or the direction of it. And so there's a lot of fear about inflation and what it was going to do. And the good news where we are in the economy today is, you're not worried about it going to 12. Now the discussion is, is it 2 or is it 4? But it's not near the size we're talking about. Now, the hard part there is when you say inflation is growing at a slower rate, it really doesn't mean that anything's cheaper. It just means that the rate of that price increase is slower than it was before. So unfortunately, nothing or broad market baskets aren't necessarily less expensive than they've been. It's just that price isn't growing as fast. So it's good news, but it's not great news.
Okay, good news, but not great news. So you did mention the Fed. Stephanie, I'll ask you a quick question here on the Federal Reserve was really expected to cut rates this year. And has that happened yet? And kind of what are we thinking to look forward to through the end of this year?
Yeah, at the beginning of this year, market participants were pretty excited about the prospect of a bunch of Fed rate cuts this year, and they've not materialized yet. And that's really because the economy's been doing much better than expected. And as we saw when Matt was going over inflation, it had came down and then just kind of stubbornly hung out around the 3% mark for a while there. So the Fed has not cut rates yet, but you can see here on the right-hand side of this Fed rates chart, the Fed's expectations and the market's expectations denoted by the blue and green dotted lines. So the expectation is that there will be rate cuts. That gray shaded area shows the range that the market expectations have taken this year. So to your point, Katie, like there was these expectations that there was going to be all these cuts, and those did not materialize. And so those expectations have changed and evolved and converged with what the Fed has been estimating. And when we look at the Fed futures today, the market is expecting that there'll be a rate cut come September.
Okay, September. So looking at that, have all interest rates then increased?
Yeah. So when we talk about the Fed funds rate, that's a short-term interest rate. But when we look at the yield curve, that is looking at lots of different maturities from 3-month all the way up to 30 years. And that gray line is showing where we were when interest rates were at their lows in 2020. And then the blue and green colored lines there at the top of this chart show some recent yield curve data. So you can see that not only short-term rates have popped up substantially, but those intermediate and long-term rates have as well, with that dark blue line denoting where yields were at the end of the quarter. Now yields have come down some recently during this spate of stock market volatility, and that's helped boost bond returns. So when we started the presentation with year-to-date returns, and bond returns were slightly negative. Well, now they're in the black.
Okay. So thank you all for sticking with us. You are now halfway through, and we now have our second poll question of our time together. And Stephanie, I'm going to have you read this one.
What is your favorite season? A, spring, B, summer, C, autumn, D, winter.
And so there, I'm sure we would love to have the E option of us Texans, where we only have 2 summers. So it's really not a choice of 4. Is it hot or is it hotter? And those are our choice of seasons. But yes, we'll give everybody a few minutes there to answer. Super technical here on some of these polling questions, but hopefully giving you excellent content on the economy. And we'll go back to Matt here in just a minute once we see those answers.
Yeah, I'm going to San Antonio next week to visit with Katie and some of our clients. And I was looking at the forecast, and the high was 101 every day. So glad we're going to be in offices and restaurants.
That's right. So autumn looks like could be why pumpkin spice is, I'm sure the announcement's coming out, if it hasn't already, that it's been released. But autumn is by far the leader, with summer following about half respondents. So thank you guys for answering that and staying engaged. We will move on, Matt, talking a little bit more about staying on that interest rate topic. And with interest rates higher, isn't that perhaps bad for the federal government and finances?
Tell you once again, another one of those tricky questions. But yes, as the interest rates move around, it certainly changes the numbers on government debt. And it's a busy chart, but kind of the key part of here is if you look in the middle of the page, you'll see this gap. And this is sort of the gap of between what the government is spending and the revenue that it's bringing in. And so this is what you have to borrow. When I read this number, I first, in my brain said 1.9 billion, and then had to remind myself that it's actually $1 trillion that's on that number. So that's what they've got to raise. And so when you think about that, that's generally raised with treasury bonds. And so certainly as short-term interest rates go up, the interest cost on those shorter bonds is, as Stephanie showed, is much higher today than it was before. But you have to remember that some of the government debt works a little bit like the mortgages. And so also, as Stephanie mentioned, that there's a certain group of mortgagees that had rates kind of more in that 3 to 4% area. It's the same way with government debt. So they sold debt several years ago and interest rates are lower. And so there is a bucket of government debt that those interest rates don't move around every time the Federal Reserve changes rates. So it's certainly not good for deficits in general as interest rates go up, but it's not quite as bad as you might think from just simple math of, how it flows through when that interest rate goes up with government debt.
And so here I'm going to introduce TICJA, which is the Tax Cut and Jobs Act. Liz, you can choose if you want to use the acronym or say it every time, and we'll count how many times you get it exactly right every time. But Matt, I have just a quick question for you before I want to hear from Liz. How is an extension or possibly Trump tax cuts expected to impact these numbers?
Yeah, so this is one of those questions where the answers are bad and worse. And so if you think about sort of the status quo, which kind of assumes that some of those things will expire. And so when you look at the chart again, it's a little busy, a little hard to see, but the darker blue line, that's kind of the estimate of the deficit if everything, right, if the tax cuts go away. And you can see that if you look on the right tail of that, that deficit number is getting bigger, even with the assumption of those things going away. And then if you look at the red lines on top, that's what would the deficit look like if all those tax cuts were extended. And you can visually see that all the red numbers are higher than the dark blue. And so it tells you that, unfortunately, regardless of what happens, the expectation, kind of as things are now, is that that deficit's going to increase. But more than likely, it would increase at a faster rate if some of those things were extended.
Oh, okay. So here, Liz, we've introduced that TICJA. It looks like the extension of that could be problematic. What should taxpayers keep in mind if this does not get extended?
Sure. So, and I find acronyms to be kind of a necessary evil. I try to say them out. We live in a world of acronyms, but under the Tax Cuts and Jobs Act, there are several provisions that, if nothing happens, are set to sunset at the end of 2025, effective January 1st, 2026. We are going to see quite a few changes. We are not covering all those today. That could be its own whole webinar, but from a high level, hitting the top things that are going to impact some of our individuals here, with the first being a rate hike. So the maximum federal rate going from 37% to 39.6, presents some opportunities for planning of, timing of recognizing income and deductions potentially. The Section 199A deduction, or the qualified business income deduction, is also going to sunset. This was essentially enacted to kind of give pass-through entities the same leg up as corporate entities that have that permanent 21% rate adjustment. And that's going to be huge for a lot of our business owners, the loss of that deduction there. The standard deduction was doubled under TICJA and indexed annually. It's going to revert back to essentially half of what it is today. For 2024, for reference, it's just shy of $30,000. But as a result, a lot of people haven't had to itemize their deductions anymore with the state and local tax deduction cap at $10,000 and the loss of miscellaneous itemized deductions under Tax Cuts and Jobs Act. This has been a simplification for a lot of people, but it's not all bad because some of those itemized deductions are now going to be reinstated. So some taxpayers are actually going to see higher deductions than they were allowed previously. The SALT cap is removed, so state tax is now deductible again. Other big ones are these miscellaneous itemized deductions. For most people, what this looks like are going to be your investment management fees. They're limited to 2% of your adjusted gross income. Those are now reinstated. So that will be a favorable deduction for some after the sunset, if not extended. But another thing to keep in mind for especially our high income earners or high taxpayers with a lot of taxable income is the phase out of itemized deductions was repealed under the Tax Cuts and Jobs Act. That will be reinstated. So for people who have very high taxable income, they might not see the full benefit of their itemized deductions anymore, potentially having the total reduced to almost 80% of that total. So that's also an opportunity to plan for charitable giving, for stacking your deductions, for taking advantage of some provisions that states are allowing to deduct taxes that flow through entity levels. So there's a lot of real planning opportunity to think through, some good, some bad. It's going to vary based on each person's individual situation, but a lot of things to consider when you're thinking about taxes over the next few years and what that potential impact could look like for each person personally. Another major thing to consider with the sunset for individuals is the sunset of the federal and estate tax exemption. Under the Tax Cuts and Jobs Act, this exemption was essentially doubled for each taxpayer. We've indexed that amount annually since 2010. So for 2024, each individual can give away roughly $13.5 million without any gift or estate tax consequences. So that is a huge difference. Post sunset, we are going to revert quite further back to half that amount, which can cost families and taxpayers and generations a significant amount of estate tax, which is going to be roughly 40% of assets in excess of that value. So there's a really unique opportunity over the next couple of years to do that proactive planning and assess estate plans. Is there a time, especially now we're talking about how assets have a higher value, is there a time to kind of maybe think of, do I have estate tax exposure? Should I be taking advantage of using my increased exemption with lifetime gifts now while I have that opportunity? We have an example here on the next slide, just showing that impact of giving away your maximum exemption under the current provisions right now, with a married couple being just over $27 million that can be moved out of the estate versus what's going to be available in 2026 at just over $13.5 million. And that estate tax savings is about $5.4 million, which compounded over time is just an exponential savings for the next generation or for the heirs of an estate. So I think that's something that we want to make sure everybody's thinking about, because it does take time to plan for that. It is a thoughtful conversation, a lot of different dynamics for each individual that could craft their plan accordingly to make sure they're taking advantage of the opportunity while they have it.
Wow, that chart alone, but also what you showed first of just all the different impacts that we could see. Certainly, as an individual, I can pick one or two out of there that are going to directly impact myself and our family. So thank you so much for sharing those details. Now I think we'll go to Matt for our third polling question. We will have 4 of those today. You are only required to complete 3 of them for your CEs. So Matt, I'm going to tee you up here on reading our third poll question of the day.
All right, I'll do my best. Which of the Forvis Mazars cities would you like to visit? A, New York City, B, Paris, C, Los Angeles, or D, Tokyo? So it's quite an expanded list from what it used to be.
Yeah. I know at least 3 of those are either Olympic cities or soon to be Olympic cities. So very top of mind with all that's been on the TV and on prime time each evening. So we'll give everybody a minute there to answer. Just in our expanded Forvis Mazars locations there, we get to have some of that global presence. And then we will have about 15 minutes to wrap it up, talk a little bit about all-time highs, sitting on cash, and then also get some closing thoughts from all of our presenters. So we will go ahead and take those results now from the poll. And a little surprise, Tokyo with 41% and Paris very close second, but Tokyo for the win. And so with that, we've talked stocks, we've talked a little bit about interest rates, and Liz with all the tax implications. I'm actually going to give Stephanie somewhat of a trick question on, with US stocks having hit all-time highs, should I keep my cash on the sidelines? And what about for a dip?
Yeah, that could certainly be one's inclination, is just keep that cash parked until they see a dip. Of course, we've seen a bit of a dip here recently, but we've had a lot of all-time highs this year, 31 in the first 6 months. And we got this question a lot. And what I think is interesting is that the chart here on the right, this bar graph, where it looks at a period of time from 88 to 23, so 35 years, and looks at, okay, well, what if I invested money any day of the week that the market is open, versus what if I invested money when the S&P 500 is at a new all-time high? And that's represented by those green bars. And you can see whether you're looking at those subsequent 3 months, 6 months, 1 year, what have you. Investors that invested at those new all-time highs did not experience subpar returns relative to the investors that just invested any market day. So just because the stock market is hitting new all-time highs doesn't necessarily mean it's overvalued. So that's just important to keep in mind.
And I know obviously more money can be made in the stock market, but CDs, what we've been seeing is 4 to 5%. That doesn't seem like a bad idea, does it?
Certainly, after having cash yields that were next to nothing, it's pretty easy to get excited about 5%. But if those dollars that you have parked in CDs are really for long-term goals, you might want to rethink that plan. Certainly, if the cash you have parked is for, say, an emergency fund or a short-term goal, by all means, keep those dollars in cash equivalents. But this chart helps to illustrate why deploying those dollars into long-term investments during a period such as where we find ourselves could be a good idea. So as we've talked about earlier, the Fed has raised rates substantially, and we're really at kind of that peak rate, if you will, on CDs. And each of the time frames denoted at the bottom are similar periods of time like this. And the gray diamonds are listing the peak CD rates for each of those periods of time. And then those bars are the subsequent 12-month returns for CDs, represented by the gray bar, blue being taxable bonds, green being US stocks, and then that light blue being a 60-40 stock bond portfolio. And when you look across all those time frames, including the most recent time frame we've been in, most investors would have been better off moving out of CDs into those long-term investments, because if rates are at their peak, well, then the next direction you would expect them to head is down. And when that 6-month CD comes up for renewal, odds are you're going to be renewing it at lower rates. Plus, lower interest rates are supportive of higher asset values.
Interesting. So looking at, the 5%, take it to the bank, 5% all day. But Liz, I think this really might be more on a tax question of, isn't that all taxable if I would just have it in a CD?
Yeah, so there's different vehicles when investing, and when you create income in a realized event, that is going to trigger an income tax, as opposed to investing in a market that just might appreciate in value. That value is only going to be captured and taxed when there is a realizable event. So yes.
And thinking about what should investors think about when they look at a CD versus a municipal bond?
Yeah, so there's various different ways buckets of income are taxed, and it's something to kind of chat with your advisors about and how that might impact you. Some is tax at ordinary, which is going to be our highest ordinary effective rate. Municipal interest might be tax exempt for federal purposes, but it is going to be taxed in your home state if it's sourced from another state. Treasury interest is going to be taxed federal, but exempt for state purposes. Qualified dividends taxed at a preferential rate, same as long-term capital gains. So there's various components that go into how these investments are taxed. Another thing I also want to remind taxpayers that I see is, being aware of having an income event might not equate to dollars in your pocket, especially if it's reinvested in your portfolio. So sometimes I see people who may have sold a lot of stock and it was just reinvested in the market, and they have a lot of income that they weren't even aware was going to be taxable to them. So in the importance of planning, having those discussions and make sure you're paying any estimated taxes that might be needed to cover those income events, so there's no surprises when your tax returns due.
Yeah. I guess that kind of leads in. We literally left it for the very end to talk elephants and donkeys. It is an election year. It is also an Olympic year, which we have touched on that. But I think we would be amiss if we didn't at least address, I think, a question that's definitely on our minds and certainly on our TVs with the commercials that we're seeing. So I'm going to pose this to Stephanie because I really value her insights. Should investors worry about their investments?
No, really. While we realize that, who holds those political offices is important, that is just one factor of many that can influence the markets and the economy. But unfortunately, political affiliation or politics can skew one's perception of how the economy is doing, which I think can really ramp up some of this angst, in addition to all the ridiculous commercials and text messages and mailers. And we've looked at the data, and you can see it here on the screen. It illustrates what I'm trying to say as far as this looks at consumer confidence for Republicans, represented by the red, and blue for Democrats, as far as if Republicans or Democrats rated the current economic conditions as excellent or good. And we're looking at 4 different presidencies here: Bush, Obama, Trump, and Biden. And when a Republican was in the Oval Office, Republicans thought the economy was doing better. And then when a Democrat was in office, Democrats thought the economy was doing better. And under all 4 of these presidencies, we had, solid economic growth. And then when we think about the stock market, while the stock market can ebb and flow over time, for various reasons, most of the time stocks are making money. And you can see here in this chart, going back to Coolidge and across all the presidencies since, that whether we were being governed by a Republican or a Democrat, for the most part, stocks were heading in the upward direction.
Wow, that is so interesting to see it, red and blue and the obvious scale there. So if an investor is worried about the election or some other major occurrence in our global societies, should they consider pressing that red button and parachuting and getting out of the market?
Absolutely not. I know that can be our inclination. Like if we are worried about something or think something bad is going to happen, and the inclination is to do something, where we really believe that time in the market is more important than timing in the market. And this chart helps to illustrate that concept. This is looking at the 20 years ending 2023. And what if an investor invested in the S&P 500 and they were fully invested that entire time? That first bar there shows you what that return would have been: 9.7% average annual return for those 20 years. Well, what if that investor decided to market time? They were worried about the markets going down, or they just thought they could outsmart the market, what have you. If they missed just the best 10 days out of 20 years, their return was cut roughly in half. And then you can see it just gets worse from there. And then in that call out box, it shows that frequently some of the market's best days are within 2 weeks of some of the market's worst days. And so it just makes market timing super tricky. And so really we just advocate for having a investment strategy and sticking with it.
Yeah, so I heard you say kind of timing there a few times. We had a question come in for a soon-to-be home buyer, so maybe first time, but just a home buyer. Any advice on timing regarding the market and rates?
I'll jump in real quick on that one. The really short answer is no. And here's the reason we don't have a recommendation. There's always kind of jokes about economists, but if you look at their predictions on interest rates of where the 10-year Treasury is going to be 1 year from now, generally they have less than about a 20% chance of getting it right, which means nobody can really tell you kind of where interest rates are going to be. So it's really, really hard to kind of time that mortgage. What I would tell you from personal experience is if you find kind of your dream home, go ahead and buy it. And if rates go down in the future, you can refinance. But if you pass up the home you really want because you want to save 50 basis points on your mortgage, you may wind up better financially and worse emotionally. And so home buying is always a little tricky that way.
Yeah. So we are about to wrap up here. We're 4 minutes before our time is up with everybody who took the time to be with us today and hopefully got some education. I'm going to open it up to each of our presenters to share their closing thoughts. Just also want to convey my thanks and gratitude for all of you taking the time. Hopefully gave you peace of mind today on a few topics that have been certainly on your mind, but then also all the insights of Liz on kind of what we're seeing on the tax side as well. So I'm going to kick it off with Liz. Any closing thoughts for our audience?
Yeah, I think just in general, anytime there is change, it means opportunity. Anytime there's opportunity, it means opportunity. So I think that this is just a time to really be thinking forward, connecting with your advisors, your whole advisor team, to make sure you're taking advantage of things that could benefit you in the long run and thinking strategically.
Matt?
Yeah, just to tag on to what Stephanie was talking about some of the best days in the market are very shortly after the worst days. And so in Japan, their markets overnight on Sunday dropped 12%, and the very next day went up 10% the following day. So if you'd sold out on the first day, you would have missed, one of the 3 best days in the Japanese stock market in, 30 years. And so volatility, it's always going to be with us. It's always going to be part of the stock market. You just got to sort of help take some of the emotion out of it sometimes.
Awesome. Well, I definitely want to be respectful of everyone's time. And Stephanie, I know you've shared so many thoughts with us today. Real quick, if you have anything you'd like to share with the audience, if not, we'll bring up our last and final polling question of today.
Yeah, I would just add on to what Matt says. There's always something one could be worrying about. There's always something going on in the news, and just step back and focus on what is most likely and what we can do to increase our odds of success, like diversification, mitigating taxes in the investment process, and those kinds of things.
All right. Well, with that, thank you again for all of your time today. We have the 4th polling question up there. And go ahead and complete it. And we are done for today. Thank you again for attending. Thank you, Liz, Stephanie, and Matt, for all your insights and your preparedness of sharing what we do every day here and the joy that we get from doing it. So thank you again and have a great day.
All right.
Thanks, everyone.